This video is a tax update on the cost of capital. I'm your professor, Dr. Stephen Haggard. The Tax Cuts and Jobs Act of 2017 did something that we haven't seen before, and that is it limited the amount of interest that firms can deduct. And so this is going to have an impact on our cost of capital calculations. In particular, in our weighted average cost of capital calculations, we multiply the cost of our debt by 1 minus the corporate tax rate to account for this deductibility of interest. But what do you do when not all of your interest is deductible? That formula no longer holds. Now, certain accountants among us will say, oh, wait a minute, don't worry, because the non-deductible interest could be carried forward to a future year when you have interest that is less than the maximum deductible amount, and you can deduct it then. Well, there's a couple of problems with that. Number one, the time value of money. And number two, more importantly, unless you are planning some sort of shift in your capital structure such that your interest is going to drop dramatically, you will probably never be able to take advantage of that carry forward of your non-deductible interest. And so what we need to do is come up with an alternative solution, how to handle this situation until the law gets changed again. I've yet to see anybody put together a way to handle this in the weighted average cost of capital formula, so I thought I'd take a shot at it myself. Now let's recall our original weighted average cost of capital equation, and that is where we take the proportion of the capital structure that is equity, which is just equity divided by debt plus equity, recalling that debt plus equity is equal to total assets. And so we've got that proportion of the capital structure that is equity multiplied by the required return on equity plus the proportion of the capital structure that is debt, D over D plus E, multiplied by the required return on debt multiplied by 1 minus the corporate tax rate. Now that's because of that deductibility of interest. But when we can't deduct all of our interest, we need to make a change here. And here's what I propose. We're going to, first of all, E over D plus E, we're going to call that W sub E, weight of equity, because I'm frankly just running out of room on the screen here. So we've got the weight on equity and the weight on debt. And we see that we've got our two terms from previously, the equity and the debt with the 1 minus T sub C, but now we have a third term. And that third term does not multiply by 1 minus T sub C because that's to account for the non-deductible proportion of interest. So how do I come up with this fraction? When I do the 1 minus T sub C term, I'm going to use the amount of deduction of interest that is deductible, I sub DED, divide by the total amount of interest, I sub TOT. I'm going to multiply that times the weight on debt times the required return on debt times 1 minus T sub C. And in that final term, I'm going to have the non-deductible amount of interest divided by the total interest multiplied by the weight on debt multiplied by the required return on debt. Notice there's no 1 minus T sub C because that interest is not deductible. Now one thing else I want to point out to you. I sub DED plus I sub ND must equal I sub TOT. In other words, deductible interest plus non-deductible interest is equal to total interest. And so those interest weights that you see there are always going to add to 1, in the same way that the debt and equity weights will always add to 1.